Still see it? Cool. Good to go? All right. Welcome, everyone. Thanks for joining me. Thanks for having me as well. I graduated in 2017, so it's nice to be back. It's been a bit. Last time I was here, the startup show was in a completely different building. So it's cool to see that you all are still improving and you have a better space than we had. So I'm excited for this talk and to learn a little bit about what you all are building. Just by a show of hands, who here is actively building a company? All right, 3 people. Who here has raised venture capital? All right. Who here is aware of how that works or how the continuum of VC and financing works for startups? A few people. All right, we're going to keep today very high level then. The important thing to know is that most businesses, especially technology businesses, they take some type of outside funding to get started. And we're going to talk a little bit about the dynamics of that outside funding, as well as what the people providing that capital, at least at an institutional or professional level, are motivated by. So for the future, if you decide to either start a business or join a business that is financed by outside funding, in particular venture capital, you'll understand what to look out for, but also how to thrive in that type of dynamic. So here's a quick overview of what we're going to be talking about, or again, kind of what the focus of this discussion will be on. I encourage you to ask questions throughout, so if there's something that you all don't understand or you want to dive a little bit deeper into, just let me know. And you can interject or interrupt me, I don't mind. Just ask questions as they come up. So kind of as I overviewed, venture capital is a powerful force within the startup world. It's typically the gas that you pour on the fire of innovative companies that are disrupting certain markets, especially at a fast clip. The thing about venture capital, however, is unless you've operated within that system or you've been on the other side of the table, the person that's actually writing the check into these businesses, you don't often know how it works, and you don't often know how the dynamics at play will affect your position and ultimately affect your success. So today, my goal is to help you all grasp that concept a little bit better, and then hopefully you can apply that as you go into the next phase of either your careers or your journey as founders. So here's a little bit about myself. I need to get a new headshot. No beard in this one, but just as a quick overview, I've held a bunch of different positions within the VC ecosystem. After undergrad, after UMD, I went straight into venture. I started on the LP side, and we'll go into the acronyms here in a bit. But at a high level, what I did when I first graduated was I invested into venture capital funds as an investor. So I was taking larger pools of capital and giving them then to venture capitalists that then took that money and invested it into startups. I worked at a couple different funds, started off here in Maryland at a fund called Greenspring Associates in Baltimore. After that, I moved out to San Francisco and worked at an early stage firm called 500 Startups. It's now called 500 Global. I was on the early stage team there as part of the flagship fund based out of SF. And I ended my tenure at that firm as the head of partnerships. After that, I transitioned over to the operating side. I co-founded a business called Built First. It's the best way to describe it is a software marketplace for early stage businesses. If you need to buy cloud credits, if you need to buy foundational software, and in some cases, if you need to engage with a service provider, we built a marketplace for you to do that. And as part of our go-to-market or as part of our distribution strategy, we would disseminate that marketplace to venture capital firms, law firms, financial institutions, and they would then pass it off to their clients. So at the height of that business, we were servicing about 15,000 startups. We were the white labeled solution for most of the large venture firms within the ecosystem. And we ultimately ended up selling that business to a much larger partner marketplace business called AppDirect. It's one of the biggest private companies in Canada today. After that, I moved out to New York, and I co-founded a business called Adonis alongside one other UMD alum. Some of you might have heard of him or heard the company, but that business is currently within the healthcare space, more specifically medical billing, so fairly relevant, just given current events. We built a set of workflows that help to automate the process of medical practices submitting claims to insurance companies. And we ultimately scaled that business from inception, or just an idea, basically a pitch deck, to almost $10 million in revenue over the first couple years of the business, raised about $50 million in venture funding, and that business is still going strong. It's led by Akash and his brother currently, and I left that business to go back into the investing side, which brings me to kind of what I focus on today. I am currently a partner at a venture fund called Coolwater Capital, and we have a bit of a unique strategy in regards to how we invest. Instead of investing directly into companies, we invest into venture capital firms. Much like a startup, a venture capital firm also has to raise money, and they go through different phases of growth, from inception to what you could consider like the pre-seed or seed stage, and then as they continue to raise funds and put out new fund products into the world, they transition over to a more established name within the asset class. We focus on the early stages of venture funds, typically fund ones and fund twos. Those are the first funds that VCs are kind of putting out to the world to kind of test their thesis and ultimately see if the market wants to buy what they're selling. And beyond just investing as a limited partner, we also take stakes in those businesses. So we treat venture funds as a typical VC would treat a startup. We buy a piece of the fund, and we take a very hands-on position in growing that business over time. Max.
Why do you think places like Blue Owl haven't done VC GP stakes yet?
A lot of it comes down to dynamics in the industry. So we'll get a little bit more into the business model of venture, but traditionally, venture funds do not sell percentages of their business, or VCs don't sell percentages of their business. They instead sell percentages of the upside that they create, or the returns that they produce through the investments that they make. We get a piece of that, but we also get a piece of the actual business. So if they ever sell, we'll get paid out, much like a typical investor would when a technology company exits. More specific, like to answer your question more directly, I think because it's just not something that's typically done in venture yet. GP stakes are becoming more popular, or like they're becoming more widely accepted, but it's still a gray area for a lot of fund managers. People aren't sure if it's something that they should do or like take on. And also because venture funds typically start really small, most larger players like Blue Owl can't deploy enough capital into those types of strategies to make it work, at least for them. So here's an overview of how we operate as a firm. Over the past few years, we've helped to co-build over 270 venture funds. About an eighth of those have gone on to raise subsequent funds so far. In aggregate, the funds that we've worked with or supported have raised about $4 billion in capital. They've invested in so far about 8,400 different startups, and we have a large network of both GPs and LPs. One of the ways that we operate within the ecosystem when we do what we do is we operate an accelerator for venture capitalists. I'm sure you all are familiar with like the Techstars or the YC, or Y Combinator, maybe the 500 startups model. Very similar to how they operate an accelerator for startup founders, we operate an accelerator for high potential venture capitalists. These are typically people that have built technology companies previously. They have a couple successful exits under their belt, and now they're transitioning over into institutional fund management, which really just means they're switching careers into being a professional investor. A lot of them have already been doing angel investing for 5, 10 plus years, and they're trying to formalize a lot of what they've been doing personally into a fund with other people's money. So they come to us, we help them structure that, and we ultimately help them build a business that is sustainable and also scalable. My partners and I have had a bunch of different experiences, but I think the important thing to know about what we do is we apply best practices to the funds that we work with. On the right are some of the funds that we've invested in, either through Coolwater or through some of our prior firms over the past decade. Some of these are names you'll recognize. Others are names you've probably never heard of, but might recognize within the next 5 to 10 years. Here's some testimonials from some of the GPs that we've worked with. Farouk, for example, is based out of SF. He's a solo GP, runs a fund called Preface Ventures. Dan Kimberling is based up in New York. I'm also based up in New York, but he mainly focuses on financial services. Makes sense why he's based out of Manhattan. And then Nadav and Ronnie, as well as Kate and Jessica, they're a dual GP team. Kate and Jessica run a firm called Hannah Gray. They focus on investing into female-led businesses or women entrepreneurs. And Nadav and Ronnie, they mainly focus on obscure business models or more deep tech type businesses. Here's some of the different funds that we've either co-built or heavily advised. I'll go through that quickly. But just to add some credibility to what I'm going to be talking about. And then here are some of the underlying companies that we've invested in or our funds have invested in over the past few years.
How long have you guys worked with Cortado?
Cortado? What is that, from this slide?
Yeah, I didn't get to know it before. It was like the second cohort, I think. The next one. Yeah.
Cortado. Yeah, they're, what? Okay, cohort 5. So that was probably back in 2021, maybe 2022. So it's been a bit. Yeah, they're probably about to raise a fund 3 pretty soon. I've said a lot so far. I may have lost some of you already, but let's kind of go back to basics. What is a venture fund? A venture fund is an investment vehicle, or what some people would call a blind pool of capital, that exists to invest into other businesses. So, baseline, pool of capital that somebody manages actively to then invest into the growth of other early stage businesses, typically technology companies. The structure is twofold. So there's 2 main players within the structure of a VC firm. There are limited partners and there are general partners. A bit of a made-up term. People typically refer to limited partners as LPs, and they'll refer to general partners as GPs. Really, the only thing you need to understand there is the limited partners are the investors into a venture fund, and the general partners are the venture capitalists that are then taking that money and allocating it to a portfolio of other early stage businesses. Limited partners are typically made up of, or the typical background or archetype of an LP is a pension fund, sometimes it's an insurance company. University of Maryland is probably an LP, or the endowment of University of Maryland is an LP in a number of different funds. Family offices, which is really just an investment firm that is made up of a single family's money. Think of like, Elon Musk, Bill Gates, those types of people. They'll have their own family office. And then also high net worth individuals. As of right now, according to the SEC, if you either have, I think it's $1 million in assets or make over 200K per year, you can invest into a venture fund, or you can invest into a private market fund. So high net worths also constitute a large part of a venture fund's LP base. that's ultimately the type of person that a venture capitalist is going out to raise from when they're trying to put a pool of capital together to then invest into startups. And then the fund managers themselves, typically the path is you either work your way up the ranks through an established fund and then go out and raise your own fund at a certain point in your career, or you have exited a business that has made you a bunch of money, and then you take that money and create your own fund out of it, and then maybe bring some people along for the ride as LPs. Yeah.
Is there like a vertical from the LPs that like dominate the landscape, or are they like simply diversified?
It's diversified depending on what stage you're at as a VC. Your first couple funds, like if you're a venture capitalist, your first couple funds are typically pretty small because you're still trying to prove yourself, and you're still trying to prove that you can get into good companies and ultimately generate returns for your investors. So the larger LPs, which are like the institutional LPs, the pension funds, the endowments, in some cases sovereign wealth funds, they're not going to pay you much attention because you're only managing like $20 million. They can only really lean in when you're managing, pools of capital that are 100 million plus. So in the beginning, it's mainly rich individuals or wealthy families that will invest into these types of funds. And then as they mature and their assets under management grow, then you have the institutional LPs that will start coming to the table. So it varies depending on the stage of the venture capitalist or the stage of their firm. But yeah, there are certain archetypes that tend to lean in at certain times within that maturity continuum. And then, go ahead.
So for the GPs, do they look at the source of capital any different, like domestic versus international?
Yeah, you have to pay attention to like the motivations of your LP or your investor base, mainly because those are the people that you're going to go back to once you go out to raise another fund. It's easier if you already know that most of your LPs are going to re-up for the next fund, but typically you're going to take money from whoever's offering it to you. Especially in this type of market, it's hard to raise for venture, and if someone's offering you money, you're typically not going to say no. Yep.
When new GPs are raising for their first or second fund, and perhaps they're not personally wealthy yet,
Mm-hmm.
what does it look like to kind of get to that GP buy-in? Because obviously they have to put up some capital for the fund most of the time for their LPs to feel comfortable.
Yeah, that brings up a good point. So there is a dynamic in all of fund management, but it exists in venture as well, where you want LP GP alignment. Basically what that means is your LP base or your investor base needs some level of confidence that you also have skin in the game. What that means is you need to invest into your own fund personally as well. You can't just go out and raise a bunch of money from people and not have anything of your own at stake. So right now, industry standard is you have to put up 1% of your fund size. So let's say you're raising $100 million. You need to put into that fund $1 million of your own dollars or $1 million of your own money. The more that you put in yourself, the better alignment there is with your LPs. Basically what that means is the more money you put in, the more confidence that your LPs have that you're going to care about the results of that capital. And it can be inferred that like the more care you're going to take to actually producing returns. So yeah, to sum this up, GPs invest LPs money into startups, and the goal is to generate an outsized return. Basically what that means is a return that will beat public market comparables, what you can get in the S&P 500 or any other type of public market index. VCs exist to try to beat that. The catch is, or kind of the trade-off is, it's going to take you 10 years, and that money is going to be illiquid. You can't take that money out as an LP. You just have to be along for the ride and ride it out for about a decade. And then hopefully at the end of that decade, as an investor in a venture fund, you're going to get an amount of money back that would beat what you would have gotten if you just put that into public equities. So that's the ultimate goal, generate outsized returns over a 10-year plus period. How VCs make money is twofold as well. And I'll go on to the structure of a typical venture fund after this so we can visualize it a bit. But there are two main income streams for a venture capitalist. And it's important to know this because this constitutes the motivations of an investor in early stage businesses or startups. The main way that VCs make money is through management fee. Management fee is defined as 2%, or typically it's some defined percentage of the total money that you manage. In venture, the typical structure of management fee, or the generally accepted management fee annually, is 2%. So each year you can draw down 2% of the capital that you manage. To make the math easy again, if you manage a $100 million fund, every year you can take $2 million out of that fund and use it to pay yourself, buy office space, pay for travel, pay your employees. It's basically your operational budget. You have to make that 2% stretch for the life of your fund each year so that you can do what you need to do and ultimately invest into the businesses that are going to provide some type of return. And just to be specific also, that's 2% annually. So over the life of a fund, typical fund's 10 years, that 2% is going to be somewhere between 10 to 20% of the total dollar value or assets under management of that fund, which seems like a lot. Go ahead.
You mentioned that you have to give in 1% of the fund.
Mm-hmm.
You're getting back 2%. Would it be possible to just take 1% and not give your 1%?
Sometimes that's what people, if you're a GP, if you're a VC and you're raising a fund and you don't have $1 million liquid, let's say again, you're raising $100 million, you don't have $1 million cash that you can just put into your fund. What some GPs will do is they'll do a management fee offset. So they will take, over the course of that 10-year period or for however long they're taking management fee on the capital, they will take a percentage of that and then put it into they'll revert it back into the fund to constitute their 1% GP commitment. So there are some cases where people will do that, and this still shows alignment, but in either case, you need to put at least 1% to the fund yourself. And just to touch on another point, so 2% annually comes out to 20% over the life of the fund if it's a 10-year fund. That's a large portion of the capital that you're supposed to invest. So typically, you will, or a VC will taper off in regards to what they're charging by way of management fee towards the back half of the fund. They might charge 2% or like 2.5% for the first 5 years. And then starting on year 6, they'll decrease it by like 50 basis points or 0.5% each year until it goes down to 0. And then ultimately, you're supposed to invest money back into the fund to kind of reconstitute the 20% you're taking out. That's not important to know right now. What is important to know, though, management fee is how VCs pay themselves. The upside, or the profit, what ultimately will make a venture capitalist rich or wealthy is the carried interest portion of their income stream. Carried interest is another term for profit. It's anything that the fund makes beyond a 1x, beyond the return of capital. And the VC's portion of that profit is 20%. So what that means is, if you have a $100 million fund and you ultimately return a 3x, so you get back $300 million, you don't take anything out of that initial 1x. Whatever has been invested into the fund, you don't get anything out of that's initial amount. Anything above a 1x, you get 20% of. So that additional $200 million that they made in returns, they will get $40 million of that. 20%. And again, that's where the generational wealth is made in VC. Go ahead.
Is 20% like the same number for all VCs, or is it different?
It's typically the same. If you are, let's say like a Sequoia or like some tier 1 firm, some world-class firm that you have a line out the door of people wanting to invest into your fund, sometimes you can say, hey, we're actually charging 30% carried interest, but the standard is 20%. It's really hard to argue that you deserve more than that, especially in today's market. Another thing to keep in mind, we kind of touched on this in the last slide, the timeline for venture is incredibly long. People will say it's 10 years, it's actually closer to 15. So you have illiquidity and just long time horizons kind of working against you. It's a really hard game to make money in. And that's why certain motivations exist within venture. We'll get to that in a second. But yeah, also just given those timelines, the time value of money, as some finance majors might understand in the room, all of that means that you have to go after ideas and businesses that could become huge. You can't invest into small to medium-sized businesses. These have to be very big outcomes for this model to work. This is a typical fund structure. We don't have to go too far into this, but typically there are 3 separate entities for a venture fund. You have the management company, you have the GP entity, the general partner entity, and then you have the actual fund. All of this is funded by the limited partners or the investors of that fund. They invest money into the fund, you take 2%, put it into the management company each year, and then that 20% of carried interest goes into the GP entity as distributions or kind of profits are distributed to the LP base. So, quick visualization, not too important that we all understand this right now, but just so you know, this is how it's structured. And then going back to the earlier comment of it's a really hard game to win, venture exists to, again, beat the market. I think anybody that's trying to create a company of not just value, but of meaning, something that like can change an industry and like improve the world for the better. We have, of course, philosophical reasons why we're betting a large part of our lives and willing to put so much at stake to make it a reality. And VCs will often play into that desire of founders to want to change the world, but the thing to keep in mind is this is a game of money and returns, and what really matters is that they make money. That's all I care about. They might like you as a person, you might be their friend, but ultimately, if you don't make them money, they can't spend time on you, and they will ultimately begin to divert their attention to parts of their portfolio that do make money. The reason being is because, again, it is incredibly difficult to make a return in venture. In this asset class, it's almost impossible. We'll dig into the math a little bit more, but this leads to a dynamic of big wins. You can only win in the game of venture if you have multi-billion-dollar exits within each fund that you bring to market. The reason being is most startups will fail. I think you all already know that. It's kind of drilled into your head as entrepreneurs. And ultimately, 1 or 2 businesses will return the entire fund and constitute the majority of return for a VC. And also, this typically only happens like once in someone's career. It's very rare that they'll have, a VC will have multiple like 5x funds. That's like an anomaly. You get that one time, and that's pretty much it. But off of that one fund where you got a 5 to 10x, you can raise another $500 million and get rich off a management fee from there. But just keep in mind, when it comes to the VC math, most startups fail. 1 to 2 companies won't return their entire fund. There is asymmetric outcomes, meaning that most return will funnel into 1 or 2 positions, also referred to as the power law. That comes up a lot in venture. And VCs don't just want a steady stream of growth. They need outlier situations or outlier companies to be successful. And what I mean by outlier is they need that company that's growing 10x, 20x, 30x per year. They don't want a business that is just doubling every year. That doesn't make them excited. I kind of touched on this a little bit ago as well, but the hard truth in venture is most venture funds will fail to return at 1x. That means the majority of venture capitalists, the majority of funds in existence, will never make back the money that was invested into them. That also means that most VCs will never actually make money. They'll just make money off of management fees and actively managing that capital. They'll never get any profit because they will ultimately never return at 1x. That's the hard truth, and that's something that most people in venture, especially on the operating side, if you're at a startup, if you're a founder, most people don't realize this, but this is how the game works. it's like entertainment or sports, anything where there is a heavy dose of asymmetric outcome, the people at the top are the ones making all the money and most other people get by. A way to visualize how VC math works is through a calculation that I refer to as the return the fund analysis, or RTF analysis. This determines the type of business that a VC invests in. It helps determine also how fast the company needs to grow to be viable, to enter into a venture capitalist portfolio. And it's a good visualization of just how the VC game works in general. So the way that this works is fund size divided by percentage owned of that business or a given business in your portfolio at exit equals the minimum viable exit to return your fund as an investor. This is important to keep in mind because as a VC, you don't just invest into one business and cross your fingers and hope that that company becomes $1 billion outcome. You invest into 20, 30, sometimes 100 out of one fund. The reason that you're doing that is you're trying to build a portfolio and you're hoping that at least one or two of those investments will hit. But also, most likely, only one or two of those investments will hit. The majority will be written off or go to zero. Some will return capital, but that's not why you're in the game. You're ultimately losing money if you're getting the same amount back that you invested in. And then again, one or two will have like a 10x outcome that will return your fund. So if we have a $100 million fund size, we'll just keep using that fund size throughout the rest of this talk. If you have a $100 million fund size and you invest into 10 companies, you own 10% of each of those companies at exit on average at the end of the 10 years. You need those companies to produce $1 billion outcome to return your fund. So just to hit a 1x, you need at least one of your businesses to exit at $1 billion. And you're not even in the point where you're making money. You're just at the point where you're breaking even. So again, huge outcomes. That's the only way that venture works. That's also why growth is so important. That's also why they only invest into, or VCs will only invest into certain types of businesses. And that's also why ambition, or like the notion of ambitious founders, is so important. If you're somebody that's trying to sell an idea that is going to be maybe at best a $50 million outcome, you're not going to excite anyone. And it comes down to the math. The math just won't work with that type of business. Another reason why all of this is really important to keep in mind is again, motivation. And motivation is ultimately derived by the fact that VCs are also raising, much like you're raising, or much like startups and founders are raising. They have to constantly fundraise from their set of investors. VCs are really just the middleman. They're taking other people's money and then funneling that money into what they view as like the best opportunity available to them at that time. So again, much like a founder or entrepreneur needs to constantly raise, or depending on the type of business, you might be in a mode of constantly fundraising. A VC is also constantly fundraising. And they need to structure their fund as well as their fund product in a certain way in order to gain commitments or gain investment from limited partners. We were talking a lot about the math behind venture and ultimately how to produce return within the game of VC. All of that is driven by what LPs want. They want a return of capital, and because venture is the highest risk asset class, they don't just want something that's going to match what they can get in public equities or the public markets. They want to far exceed what they're going to get just by investing into a public stock. So if the S&P, let's say over a 10-year period, annually it'll produce a 10% return. If they invest into a venture fund, they're looking for a 20% return. And sophisticated LPs have developed over, I'd say that the contemporary venture market is probably about 20 years old, since like the dot-com bubble. LPs look for very specific things when they're determining which funds to invest in. That ultimately comes down to unique access. So they want to invest into a VC that has access to a type of deal or a type of entrepreneur that other people don't have access to. They look for a thesis that's going to make money or likely will make money, and they want a world-class team, somebody that knows whatever market that they're investing in like the back of their hand and has some unfair advantage in regards to their background or the makeup of their team that's going to lead to success. They also want a repeatable process. They don't want somebody to just get lucky. They're looking to invest into someone that has developed a system for identifying the best founders and getting into money-making opportunities, and they want scalable outcomes. Ultimately, what that means is they want big exits because they also know that's the only way that the math works. So as you go through fundraising for a startup or a company that you might be building, just keep in mind who you're raising from likely has to do the same thing, and it's even harder on the other side of the table. This is a typical fund manager evaluation framework. These are the types of things that, it might be hard to see, but these are the types of things that sophisticated limited partners or investors in venture funds look for. This is how they underwrite a fund investment or a fund investment opportunity. Again, it comes down to organization and team, past performance, investment strategy, and also the structure of that fund product and the terms that they're going to agree to when they hand their money over. I've been alluding to this throughout the entire presentation or the entire talk, but these incentives ultimately shape behavior, and it ultimately shapes how the startup industry works, at least here in the US. Companies need to grow really quickly. If you're not expecting to grow quick as an entrepreneur, that's not your goal. You probably shouldn't raise venture funding. You shouldn't go out and try to raise VC dollars. You should just bootstrap that business or go out for some other type of financing that's not going to put as much pressure on you to grow quickly. VCs also focus on big markets. The way that I look at it, kind of the number I work off of is 2 billion. If a market isn't currently 2 billion in size annually, it's probably too small for venture. And they also want, VCs also want markets that are growing at a rapid pace. Let's call it 10% plus per year. And they want founders with, I mentioned this before, ambition. They want to build something really big, not just something that, again, is going to be a $50 million, $100 million outcome. We're talking multi-billion-dollar outcomes. They want to invest in things with a clear path to exit. They put their money in something. They want the ability to get it out at some point. And the expectation is the companies that they invest in are going to continue to grow and to continue to raise money. I won't touch too much on this dynamic, but a lot of fundraising on the investor side of venture is determined by how well their companies raise subsequent funding after a VC puts their dollars in. So for example, if I'm investing at the seed round, I want that startup to very quickly get to Series A, so I can go back to my investors and say, hey, that company that I invested in at a $10 million valuation, it's now worth $20 million. So even if it's just on paper, I have 2x money in like a year. That they want those types of outcomes, and they want that type of quick return. But.
With early stage venture, and with how like fast some of those companies are growing at the time they release, especially without like exits, how does dilution play into like the scope of what GPs look for in terms of their initial investments and then like exiting the positions and such? Because if you can get diluted a lot very quickly if you invest in seed and then they're in Series J.
Yeah, dilution's super important, and it also relates to the return to fund analysis, the equation that defines the math behind venture. You want to own as much of a business as possible. You have to build a portfolio, so you can't just go out and buy majority positions in, 20 companies. You're buying 5%, 10% at a time. But you also have to account for how diluted or kind of how much your position is going to get chipped away at as that company has to go out and raise additional funding. So it's part of the calculation, and it's part of the underwriting or diligence process that a VC will put a company under as they're thinking through whether or not they want to invest. If they're doing their homework, they're building models that determine, okay, if this company raises an additional $100 million in financing, what is that going to do to my position or my ownership in the company, and what does that mean for my return when that company ultimately exits? So it's super important. What's also really important beyond just how much you own is how quickly that company gets to exit. If you own a small amount, but that company exits in a year, that's a great return. If you own a big amount, but that company took 20 years to exit and it's not a huge outcome, then it still doesn't matter, and that money's, compared to the public markets, the return is probably terrible.
Does Coolwater as a fund have outside LPs?
Yeah, we have outside LPs as well.
How do you underwrite your GP stakes? Because it's kind of more of like a private equity position in terms of like cash flow. It's
Yeah.
like a venture. It's not the same thing.
Part of the bet that we're making, or like part of our analysis, is based around what we think that GP or that VC will be able to do by way of like subsequent funds. What I mean by that is, because we're buying not just a percentage of the profit, but we're buying a stake in that business, we will ultimately get perpetual income streams through management fees. So we'll get a percentage of that 2% every year that VC takes. So we not only want to believe that VC is going to be able to produce outsized returns, we also need to believe that over like a 10-year period, they're going to be able to raise an additional $100 million or $200 million, because that adds to our return. If we're getting, let's say, like 10% of their 2%, on 30 mil, what is that? We'll do quick math. 6 million, 10% of 6 million, that's 600K that we're getting on top of whatever return we get out of their fund each year. So it adds up. But yeah, that's how the calculation works for us.
Is the planned exit to sell it back to them?
No, no. It's hard to structure this type of investment into a fund because that income stream could last forever, potentially. But no, it's like a dividend. We're not going to give it back to the fund. We're going to either give it to our LPs, or it's just, the cherry on top for us.
So may I know what softwares are used, you guys use to manage your finance or background checks?
For background checks?
Yeah, anything that comes to process, like managing funds or finance or doing background checks, like streamlining work.
Yeah. Depending on like what type of firm you ask, the answer is going to be different. If you're an earlier stage firm, or like you're on your fund 1 or fund 2, you don't have a ton of money to pour into software. Like, you just don't have a lot of expendable capital that you can invest into nice to haves. So most of the time you're using Carta or some type of like best in suite solution for managing a venture fund. Once you get to a certain size, you engage with specific lawyers and accountants that are basically third parties that will take care of that entire part of the business for you.
So use Carta.
Most fund 1s and fund 2s will use like a Carta or an Angel List. There's other like fund management operating systems that are coming out that are competitors to that realm of software provider, like a Sidecar or a Vector, but you're typically using some type of software platform that will help manage that for you. Yeah, but it's expensive. We're talking like 50 grand a year for something like that. Yeah, which is cheap. Yeah, I mean, you could spend that just on one deal, depending on like the size of deal that you're doing on lawyer fees. So everything that you're going to get at that stage is very cookie cutter. You're not doing anything outside the box. Once you want to do something outside the box, the price becomes a lot more expensive. Go ahead.
You mentioned that it takes about 8 to 10 years to realize the returns. Let's say there's like a new VC in the space. How do you evaluate that VC? Because it hasn't been around for that long.
Yeah, that's a great question. If you are evaluating a first-time fund manager, so a GP or VC that is managing outside capital for the first time, you are looking at their previous track record, which is typically either the companies that they've invested in as an angel. You want to see like how well they've done in those investments. Or if they're spinning out of an existing firm. Let's say they were a partner at an existing venture capital fund and now they're spinning out to start their own fund. You will look at the investments that they've made while they were part of that firm. And you try to determine if they've previously generated a level of return that gets you interested and constitutes taking a risk on their first fund. But everything's based off a track record. So even if like you are a first-time fund manager, typically you've been building enough track record for like 2 decades prior that gives LPs confidence that you're not going to just blow their capital. Go ahead.
I have 2 questions.
Sure.
First one, I just say this is a really fascinating presentation. I learned a lot.
Thanks.
Curious, you had this picture of global limited partners, I believe, once I was misinterpreting it,
Mm-hmm.
on Coolwater. I noticed a lot of them are what I would think are venture capital firms or private equity firms. I'm surprised they're giving you guys money to then give to other venture capital firms. How do you guys convince them to do that?
I wouldn't say, most of the time, LPs, at least in our fund, are not other VC firms or PE firms. Sometimes it's, more often than not, it's going to be an individual that either founded a large venture capital firm or private equity firm. They have hundreds of millions of dollars now, and they either want to invest back into the industry that made them insanely wealthy, or it's just part of their portfolio allocation strategy, and they are giving you a sliver of what their part of their portfolio and venture constitutes.
So that slide we had, like, Tomo Bravo, not LPs.
Those are funds that we've invested in.
I see.
Yeah. So we're LPs in their fund.
Okay, even SAKR, which I think would be like some kind of deployment client, like you guys are asking.
So we didn't do it through Coolwater. This is through previous firms that either myself or my partners have worked at. We, at those firms, managed billions of dollars, and we took a percentage of those billions of dollars and we put it into firms like a KKR or a General Catalyst. And then they then take that capital and do some type of leverage buyout, or if you're a General Catalyst, you're doing like Series B deals.
Okay, last one.
Yeah.
I think you mentioned Fund 8 of your accelerated VC guys. There's a second fund. Do you have any kind of takeaways of what makes these guys better than the rest? Is it luck? Is it skill? Maybe it's both?
It's a little bit of both. The common adage is like the harder I work, the luckier I get. So it does take some luck. Typically that luck has been built up over, again, a couple decades of just hard work and compounding success. But a lot of it is skill too. That's why you'll see a lot of previous operators or founders that move into VC at a certain point. They understand what it takes to build a business of a certain size, and they've built up over time enough pattern recognition to identify other people that are also capable of that. So it takes, a combination of both. What ultimately allows somebody that is that has recently done a first-time fund and is now transitioning to a fund 2, what enables them to raise that second fund, because that's actually a really hard thing to do. It's easier to raise just one, much harder to go back to your LPs and ask for more money, and then more money again for a third fund. Typically they have some type of early exit or early fund returner or distribution that gives LPs capital gives LPs money back much sooner than they may have expected, and it's a lot easier for them to then ask for more money at that point. And just to finish up, I'm happy to take more questions. So what all this means for you as potential operators or potential founders is think before you fall into the potential trap of taking outside money, and also think about who you're taking that money from. VC is not for everyone. And I don't mean just as a career path, I mean as a potential form of financing for your business. I'd say maybe like 2% of businesses are truly fit for this type of funding. So think through what type of journey or torture, maybe put more directly, you want to put yourselves through for the next decade. Because once you take VC dollars, you are committing to a certain level of growth and a certain level of pressure if you're going to be successful. I'm not saying that to say that it doesn't work out for people when they take it, but it's something that you really want to think long and hard about when you're determining in the beginning how you want to build your business. Also, as you were asking before, dilution is a big part of the game. Think about how you're preserving equity for yourselves as you raise money. And then also think through the terms that you're accepting when you take outside capital. Think of taking outside capital in a startup environment as a marriage, because you're going to be working with those people for potentially 10 plus years. So make sure you're aligned, and also make sure that you have a similar view of the world. So just as they're kind of doing diligence on you and underwriting you, do your diligence on whatever investor you might bring into your cap table, and make sure that you all want the same thing. And a few final takeaways. You all can read through that yourselves. And yeah, we have a few minutes for questions if anybody has any. I know we've been answering some as we went along, but yeah, just in general, before we officially end, thanks again for the attention and the engagement. I really appreciate you all inviting me here and letting me talk through some of this with you. And if there's ways I can be helpful to you all, please do let me know. But I'll reserve a couple extra minutes for questions, so if there's additional things you want me to go through, just let me know. All right.
Can you just give some tips on like how do you know which VC is like right for you? Like if you should pinpoint it or not?
Yeah, I would. What you should do is think about your business as an investor and try to take yourself out of the situation. So as invested as you might be personally in like the success of this business, if you were viewing it as somebody that was a third party or someone that was not intimately involved, how would you view that business? Does it have the potential to be a massive outcome? Are you going after a problem that is huge and affects a lot of people? Is the market already really big? Are you innovating in a space that is undergoing a lot of change? If these answers are all yes, then okay, maybe you should consider taking outside funding in the form of VC dollars. If the answer is no, then you should be very critical and make sure that you're being honest with yourself. Don't try to convince yourself you should do something that if anybody else evaluated your business, they wouldn't agree with. Cool.
What's your opinion on the market, the VC market right now?
It's a tough time. It's probably the toughest time to be in venture in the last, definitely the last 13 years, maybe the last 20 years. The issue with venture right now is there's no liquidity. So there are a lot of companies, it starts at the company level. There's a lot of portfolio companies that have raised hundreds of millions of dollars. On paper, they're worth billions of dollars. There was a lot of hype around venture and tech in general in the early 2020s. And people are unfortunately having to deal with the negative repercussions of that, because all this money's been put into these businesses, the prices have been bid up, but when you really look at the fundamentals of these businesses, it's hard to constitute a multi-billion-dollar valuation for a company that barely makes $10 million in recurring revenue. So there's that dynamic at play. People are realizing that there wasn't much discipline around how investments were made over the last, let's call it 5 to 8 years. And a lot of LPs, more so wealthy individuals, family offices, the type that get scared under tough market conditions, they're realizing that this money that they poured into the asset class, they might never be able to take it out because these businesses aren't exiting. There's virtually no IPOs right now. M&As are up, but only for certain types of businesses. And acquiring companies are being a lot more strict around the fundamentals that they need to see in order to buy a business. Whereas 5 years ago, You could buy a business just off of hype. Like a board could be convinced, oh, we should buy that business because people are talking about it. Those days are over, at least for now, but everything's cyclical. So venture's not going away, and it's super important to just like general innovation. You have to have a way to finance companies that take a lot of money in the beginning to get started. But yeah, I think there's going to be a big downsizing in the amount of firms that are available or like active. And yeah, a lot of people are going to go out of business, unfortunately. But venture as a whole is not going to go away. It's just, yeah, tough time, and probably be a tough time for venture for the next like 3 years. But it's still a worthwhile place to spend time in. If you want to build a career in it, it's still a lot of fun.
Somewhat of a morbid question, but do you feel like you see what you with you afterwards? Go back to work at your company?
I have a lot of friends that. Well, I'll answer this question in a different way. If you all are thinking about going into venture or you have aspirations to become a VC, I would encourage you to first build some real tangible skill that you can market in case you go into VC later and it doesn't work out. Learn how to sell, learn how to build things, learn how to even like market a product. Learn a skill that is marketable in today's employment economy, and start there. If you still want to do venture afterwards, then try to transition to it. But I would suggest against going straight into venture out of undergrad, because you're not going to build real skill in VC, at least not initially. And you're going to be doing a lot of the grunt work. It's not going to be as glamorous as you might think. So your question was, what do you do if you fail, right, as a VC? If you're raising your own fund and you're successful in that, you get a fund off the ground, you won't know you're not a good investor for about 10 years. So typically what happens is someone will raise the first time, like GP will go out, raise a fund. On paper, they're doing okay. They'll go raise a second fund in 3 years. On paper, they're still doing okay. They'll raise another fund, so fund 3 at like year 6 or 7. But by year 10, their LPs realize that the first fund that they raised is terrible, and they won't raise any more money, and their career's over at that point. Well, hopefully in that 10-year period, you've made enough money to kind of support yourself for the rest of your life. If not, you just go back into, managing a team at a startup or something like that. I have a lot of friends also that they started in VC, or maybe they started in banking, they went into VC for a bit, they realized how difficult VC can be, and they just went back into banking, or they go back into consulting.
Yeah, since you are very first time, so if I had to venture into partner marketplaces, what are the constraints or challenges still need to be solved in this partner marketplace?
Can you ask that one more time?
Oh yeah, so since you are very first time, so if I had to build any product for partner marketplaces, what are the unmet requirements or white spaces in this industry?
Oh, for partner marketplaces?
Yeah.
Are you familiar with so there are a lot of like consultants that will help small to medium-sized businesses determine what type of software they need to get off the ground or like ultimately make their business more efficient. There's a big white space there right now amongst just business consultants in general. I would build in that space. The issue is the revenue isn't recurring. They get paid off of like affiliate revenue basically. So partner marketplaces, the big issue right now is most of the revenue that they make is not recurring. You get paid commission per each purchase that you make, or each purchase that someone using your marketplace makes. So let's say they spend $100, you'll get $1. The big white space is trying to determine how to make recurring revenue off of those inconsistent purchases. If you can figure that out, then you can build a massive business in that space.
So it's about connecting the buyers with the tech consulting companies. That's the white space you want.
Yeah, but you need to connect them in a way where revenue is recurring. It can't just be like they make one purchase through your marketplace and they never use it again.
Thank you.
Yeah. All right, I'll take one more question and then we'll end for the night. if there is a question. If there isn't, that's fine too. All right. I think we just end it here then. Thanks again, everyone. It's been fun to be back on campus. And yeah, my email is sean@coolwatercap.com. If any of you have